Hello and welcome to the look ahead for the week commencing April the 28th. With me, Fiona Sincotta, Senior Market Analyst at City Index. So as always, I'm just going to ask you to take a quick read through the risk warning whilst I pop myself on mute. Okay, so let's kick off. I mean, it's obviously been another busy week. Just having a quick look here at pulling up here the S&P 500. So, I mean, as far as sort of main drivers across the week that we've just had, the concern, Trump's trade tariffs developments have really dominated the week. And also, I mean, whilst there's still a lack of clarity over exactly what's going on, the tone does feel more optimistic on hopes of Trump potentially softening his stance, as well as China softening their stance more recently. The latest development is that China has granted US import exemptions from its 125% trade tariffs. Now, this is the clearest sign yet, I think, that Beijing is worried about the economic fallout from a trade war with Washington. It's really ready to de-escalate tensions between the world's two largest economies. Also, we've had earnings on the corporate earnings front. We've seen some resilience, particularly from the likes of Alphabet, offering relief that their profit margins are holding up better than feared. And as a result of this more upbeat mood, we have seen that stocks are actually set to gain across this week. We are also expecting the US dollar to post modest gains this week. And gold, which reached a record high, let's just bring that one up actually, because that's a great chart. Gold, which reached a record high this week at over 35,000, just around $3,500 the ounce, has fallen back from that record level as the mood improves. I think gold is, as we know, safe haven. It's going to be a really interesting one to watch. Just technically looking at what's been going on here, and we've had this absolute phenomenal red rally, not just over the past, few months of 2025, where it was up at around 26% across the year to date, but also across, the past few years. Even if we just pan out, we can see, that's been an extended rally that we've seen in the precious metal. Now, interestingly, we have seen a fallback, but that fallback is actually rather irrelevant compared to the impressive gains that we've seen over recent years. So, and also to be expected, if we just look at the chart, there's that long upper wick there, which does suggest that there wasn't actually much buying demand at those higher levels. That we've seen it move out of overbought territory. So a period of consolidation, isn't unsurprising if you have a move away from that overbought level. Testing this support zone here, this is around the level around the 32.85 down to around the 32.45. That's a support zone that the price could be testing if we see that the mood continues to improve surrounding trade tariffs. But obviously, I mean, there is still a lot of uncertainty. We don't really have too much clarity on what's going on as far as US and China is concerned, although there is a sense that the peak of uncertainty is behind us and we're moving towards more de-escalation. So just as far as next week goes, I think before we jump into the economic calendar, which there is plenty to be looking at, we also have earnings. We'll have a look at the NASDAQ, given that we've got the Magnificent Seven are reporting lots of tech stocks in focus. Earnings, as far as earnings are concerned, they're going to be ramping up with Magnificent Seven stocks, including Meta, Microsoft, Apple, Amazon, Obviously, these are coming after Tesla and Alphabet reported this week and posted gains following their results. So the outlooks for these companies are going to be watched very closely as well. But yeah, broadly speaking, I think Q1 earnings have been holding up and have provided a positive distraction from the trade tariff story. As we can see, as far as the price is going, we're actually at a pretty key level right now. We've recovered from that low on the Nasdaq of the 16,325. We're just around here, which is the 19,250, which was the high that we saw on the 10th of April. So if we can really get a close above that level, that would be an encouraging sign, negating the near-term decline. We've obviously risen above that falling trend line dating back to the all-time high. So if we can get a rise above that and look towards the 20,000 level, which is also the 200 SMA. On the downside, failure to get a close above that level, then potentially we could be looking at a fall towards the 18,200 and 18,300 level. That's if the trade tariff story sours as well. It would take a fall below the 17,650 to create a lower low, therefore extending the downward move. So what else to be watching? We've got a lot of US data, pretty key data points out next week. So let's just have a look. This is the economic calendar. I have filtered it, so we've got next week and also the high impacting things to be watching. So obviously there is at the start of the week we've got Australian consumer confidence. We've also got some Chinese data which will be closely monitored there, and also not consumer confidence, inflation, Australian inflation. We've also got Eurozone GDP, Eurozone inflation, which we'll talk a little bit more about later, but I'm just going to jump straight in there with the US stuff, because given that the US does seem to be quite a driving force right now as far as market sentiment is concerned. We've got here US core PCE, US GDP, that's on the Wednesday, ISM manufacturing, and then we've also got non-farm payrolls, which are due on Friday. So just starting off with US GDP. Now we know that the US economy grew more than expected, or grew at a faster pace than expected in Q4 of last year. That was at 2.4% annualized. However, expected growth for Q1 2025 is expected to be significantly lower at around 0.4%, as we've seen consumer and business confidence deteriorating owing to these trade uncertainties. Now, the Atlanta Fed GDP Now model currently estimates a 2.5% contraction. So that's suggesting that there are plenty of downside risk to this major data point, which is one of the first major data points on how tariffs could be sort of shaping the economy and the likelihood of a recession. And then we've also got US core PCE, Federal Reserve's preferred gauge for inflation. Now that's expected to ease considerably to 0.1% month on month, down from 0.4% previously. Now, weaker inflation obviously raises the likelihood of the Federal Reserve cutting interest rates. However, it may also highlight a fragile consumer backdrop. So just be wary. It may not necessarily be the bad weak inflation is good news type of response. We've heard from Federal Reserve Chair Jerome Powell and several Federal Reserve speakers who have suggested that they are in no rush to cut interest rates further, given the uncertainty surrounding trade tariffs and the outlook for the US economy. So that's going on. And then, so let's just, whilst we're talking about that, just let's take a look at levels for the S&P 500. So again, similar to the Nasdaq, we've seen this recovery from that multi-year rising trend line and from the 4,800 level. More recently, we've seen that rebound from the 5,100. testing this level here, 5,500. That's the level that we need to get a close above in order to really negate this downtrend. We're just trying to get above that falling trend line. The RSI is neutral, not giving too much away. So, I mean, it depends a lot on how we behave around this level. If we can get above that, that's going to be an encouraging sign, especially if we get a close above that, a weekly close above that. Then we'll look towards the 200 SMA at 57.50. Failure to take that, we're going to open the door to support here at 54.00, and then we've obviously got the round number 53.00 ahead of that 51.50. As far as the data is concerned, I mean, if we get upbeat GDP data, then that could also help push those shares higher. Obviously, if we get severe weakness in this data, then that could raise those recession fears and pull the stock indices lower. So just sticking with the US as well, we've got the US non-farm payroll. And basically that's, we in the March reading for US non-farm payroll, we saw the report show 228,000 jobs were added. That was well above expectations. But February's results were also downwardly revised to 117,000. The unemployment rate held steady at 4.2%. That was slightly, it rose to 4.2%, which was slightly above expectations. But that was due to the higher participation rate. But unemployment has broadly remained between the 4% to 4.2% across the past year. So that does align with Federal Reserve Chair Jerome Powell's assessment that the labour market is broadly in balance. There's been no data yet that's really raised too many concerns. Even jobless claims are still holding up and showing a level of resilience, and they're quite timely. So expectations for the April payroll are for 175,000 jobs to be added and for the unemployment rate to remain at 4.2%. The market continues to price in 80 basis points of Fed rate cuts this year, with the first move fully priced in for July. So let's just have a quick look at what all this means across the US dollar. This is the US dollar index. Actually, we've just seen a slight recovery this week, as I mentioned, from that low that we saw down there at the low of, just bear with me, what was it, 97.92. That was the low that we saw this week. Have recovered from there, set for a very modest weekly gain. This could be technical though, because we were very oversold. So, I mean, buyers would need to get above that sort of 100 level in order for this to be sort of any sense of a stabilization in the sell-off, because otherwise it looks like we could continue to see further lower lows, given that the RSI still is below the 50 level. So a close above 100 could be quite interesting on the upside. Failure, if we get weak data next week from the US, then we could be looking for taking out of the 99 level. Even if we sort of see trade headlines quieten down, the market's going to be looking at the hard data now and seeing what these actually all mean as far as growth is concerned. So slight recovery in the dollar this week, very slight. Weak data next week could put that under pressure. But if we get encouraging trade tariff headlines, then that could help stem a recovery. Interestingly, look, this is the pound US dollar. We're just trying to see whether this is a double top formation. Obviously, we've seen a strong recovery from GBP USD from that 121 low to that 134.30 high. There isn't much going on as far as the UK data is concerned next week. So if we do see a further weakening of the dollar because we're seeing weak data, still concerns about trade tariffs, then we might be looking to take out that level at 134.30 to head towards the 135 level and on towards the 136. However, if we find US data is holding up, if we find that optimism remains or grows even around a trade deal between the US and China, then we could see this fall away, potentially looking for that double top formation. On the downside, watch out for 132 and then 131 as levels of interest. Now, other points to be watching out for next week. We also have the Bank of Japan. Let's pull up USD JPY. Obviously, the yen has been benefiting greatly from that safe haven flows amid the concerns over US trade tariffs. We've seen the pair continues to trade in this falling channel. What's going to be expecting on Thursday? The Bank of Japan is widely expected to keep interest rates unchanged at the 0.5% level after raising rates by 25 basis points in January and pausing rates in March. There were no rate hikes or cuts, or shall I say, not that Japan is looking to cut rates, but anyway, they are looking to hike. So, I mean, given that there is no rate hike expected from the Bank of Japan this meeting, the focus will be very much on their economic projections and guidance. The market is pricing in around another 25 basis point hike in the second half of this year. However, I think it's going to be really interesting to see how this plays out because there are downside risks to growth owing to the global trade tensions and a lack of progress in US-Japan trade talks. So that supports a more cautious view from the Bank of Japan this year. However, we have seen core inflation in Japan rise to 2.9% annually in March. That's its highest level in a year, highlighting that there is underlying price pressures. Now, so that's interesting, although we know also the Bank of Japan watches wage growth quite closely, and the wage dynamics are acting as a constraint right now, given that sort of inflation adjusted real wages are actually continuing to decline, which could weigh on household consumption. So potentially until that metric turns positive, we could see that the Bank of Japan will be tempted to remain on the sidelines. This is US dollar, Japanese yen. Again, we're seeing this mirror what's going on with the US dollar. We've seen that recovery from that low 140 level, again, a key level. So, you know, think about across the currencies, we've seen that 134 level in the pound, we've seen the 115 in the euro US dollar, which we'll look at shortly, and the 140 level in US dollar, Japanese yen, you know, pretty key levels. Seen a recovery from that. We're testing here the 143.50. Can we get a move above it? If we can get a move above that, that's going to be an encouraging sign to head towards the 145 round number. Nowhere near getting towards a higher high until we get towards the sort of the 148 level. Okay, so but we could see a negating of that near-term downtrend if we get above the 146.20 level. That could negate the downtrend. So again, want to be watching. RSI is pointing higher, suggesting that momentum is slowing to the downside, but it is still below 50. So yeah, we're going to be watching to see what happens there. Then we've also got Eurozone CPI. Eurozone inflation, the harmonized inflation is expected to cool down to 2%, bang on target for the ECB, down from 2.2% year on year. Now, CPI is expected to be heading lower as well. Interestingly, the market's going to be watching this closely, particularly as we've also got GDP data out this week. So it'll be interesting to see. Obviously, there are concerns regarding the growth outlook for the Eurozone economy, given Trump's trade tariffs. So any sense of weaker growth in Q1 and weak inflation could again be one of those things where it just really does raise concerns over the health of the Eurozone economy. Rate cuts, ECB have cut rates 7 times down to 2.25%, potentially looking at another cut in June, particularly if we see weaker than expected inflation and a downward revision to growth. As far as the euro US dollar is concerned, we've been up to that key level there above the 115. That's the sort of, we got up to 115.75, I think it actually got up to, but 115 is a very, very key round number as far as the euro is concerned. up there, we've come back down, just consolidating, bringing the RSI out of overbought territory. Just waiting to see what happens next. Obviously, as I said, the euro has benefited greatly from the sell-off of the US dollar. So if we do see that recovery in the US dollar, then we could potentially see this pair come under a little bit of pressure. I mean, level to be watching on the downside, I mean, immediate levels to be watching will be the 113. As long as we can stay above 113, then we're still in consolidation mode. I think it would take a move below this level around here, the 112 level, to be sort of negating that near-term uptrend. And again, we wouldn't be seeing sort of lower lows until we get down to the 109.40 level, so still some way to go there. Also, let's just have a look at what is going on as far as the DAX is concerned. Super recovery, much stronger in Europe than on the US, as we've seen that asset reallocation away from the US picked up from the 18,800. We're above the 200, 100, and we're testing the 50 SMA as we speak around that 22,250 level. Above here, we're going to be looking at 22,700 and 23,000 round number as we head our way back towards that all-time high. The RSI is positive as well. So, you know, if we get some more good news as far as, or de-escalation as far as US and China is concerned, then that could help the German index outperform the US and potentially move higher as well. So that is everything from me. I hope that you've enjoyed what you've seen, and any questions, then please do reach out. Otherwise, we'll see you next week.